Welcome to another episode of Intelligent Investing Market Talk series. Today we're diving into one of the most overlooked yet most important parts of investing, risk management. We often hear that investing is about picking the right stocks. But here's the truth. Even the best stock pickers make mistakes. What sets successful investors apart? It's not just what they buy, it's how they manage risk. Joining me today is Charles Ang, Head of Research here at COL Financial, to break down how smart investors think about managing risk. So thank you, Charles, for joining me today.
Thank you, April, and thanks for inviting me here, and congratulations on your channel.
Oh, thank you so much. Okay, so let's start with the basic, Charles. So why is risk management just as important as stock picking?
It's important because while the stock market is proven to be, a very good asset class over the long term, the reality is it's also probabilistic. And by probabilistic, I mean that there's a lot of uncertainty, right? And that's because in the market, we're always dealing about things in the future, right? And so these are all uncertain things, right? Will we go into a recession? Will the Fed cut rates? Will AI disrupt a particular sector? So we can make, and we should make educated guesses, but we can never really know, right? And secondly, if you really think about it, right, when you enter a trade, there's always a counterparty. When you buy, there's a seller and vice versa. So almost by definition, one of you will be right and the other will be wrong. And on average, you can say half of your trades would be wrong, right? So risk management is all about making sure that you remain in the game even after those mistakes, right? So it's balancing the goal of maximizing our returns over the long term, while at the same time making sure that we remain in the game.
Mm-hmm. So in other words, even though, let's say you're an analyst, you do your homework, everything, and even if things look all right, since everything's fluid, you can also make mistakes.
Yeah, exactly. Yeah, because the counterparty is also doing the same thing, right? They're also looking at the same things that you're looking at, and then all of you are trying to gauge everything to make the most informed decision that you can make.
Okay. And so that said, though, what is the reason why you think many investors underestimate risk?
I believe it's because we just don't like to think about the possibility that we're wrong, right? I think that's human nature, that imagining that scenario wherein we're going to be wrong and we're going to lose money is uncomfortable, if not outright painful, right? So we just rather try to imagine the things that we can buy if the stock price doubles, rather than how much we're going to lose if it falls by 50%. So it's hard, but at the same time, it's necessary if you want to be more prudent in investing.
Yeah, I guess it's just human nature. Like, we have to be more optimistic and positive about things. And maybe also, as they say, there's this element of greed. If you know somebody who made a lot of money, and then you think, oh, I could have made more if I had bet a bigger amount or if I'd bought this stock, then maybe in a way also, you throw risk out of the door.
Yeah, that's true. No? So, and there's nothing wrong with being optimistic or of wanting to maximize your gains. There's nothing wrong with that. But it's, again, all about balancing, right? So you're balancing the want to maximize returns with the risk of not making it to do the following trade. Yeah. So it's all about the balance.
Yeah, I always remember one of the advices that I heard about managing risk. Like, when you make a bet, you just better make sure that if you make a mistake, it won't be fatal. So
yes.
That you're out of the game and you cannot participate anymore.
Yeah, exactly. It's the same way. Maybe an analogy that I could share is like in driving, right? Of course, we want to get from A to B as fast as we can. And speeding up would help us do that. But there's a limit, there's a point wherein if you speed up too much, then you might not make it there. You might get into an accident and not make it to your destination.
What are the common mistakes that you often see in terms of risk management?
I generally like to break down risk management into three parts. So the first part, starting sizing, and exiting. So let's go to starting first. So for starting, that's the amount of capital that you are allocating for your whole portfolio, right? So a common mistake here would be investing money that you need in the short term, say 1-2 years, right? So this amount shouldn't be invested because, of course, we don't know what's going to happen in the stock market, especially in the short term, right? Another mistake would be simply investing too much, allocating too much, right? And this is particularly true for let's say older people who are, let's say, in their retirement or close to their retirement, right? And maybe people who don't have extra sources of recurring cash flow, right, outside of stock.
So what would be an ideal amount to invest? Like, would you have or some general rules to follow?
Yeah. It's hard. Yeah, it's hard to give an exact number because it's very personal. It's case to case, right? But as a general rule, the younger you are, the more you can take on more risk, right? So you can allocate more to your investments, right? But as you get older, as you approach your retirement, right, it should go down gradually, and maybe at retirement it should be maximum 20% of your net worth in stocks, right? But the younger you are, you can definitely take more risk. Another consideration is as I mentioned a while ago, your other sources of cash flow. The higher your passive cash flows from other sources, the more you can take on more risk because you don't anticipate having to withdraw from your investing account to fund your short-term needs.
Yeah. In other words, you don't want to be put in a position where, let's say, the market is down, your stock position is down sharply, and then you're forced to liquidate.
Yeah. Yeah, because again, it's very unpredictable. We don't know what's going to happen in 6 months, in 12 months. So ideally, it's really for long-term money.
Mm-hmm. What about, the second part that you talked about, sizing of your trade? Like, how should an investor manage their risk when they're trading, like diversification, stuff like that?
Yeah, so that's the second one. So sizing, so that's the amount of you're allocating for one trade, right? And for sizing, common mistake would be betting too much. And the extreme case would be going all in, or some even use leverage to buy a stock, right? And those are not necessarily ideal, right? Because again, the goal is to survive mistakes, right? So instead of that, of course, for investors, we advise diversification to limit impact of any one mistake. And for traders, there's also a concept called value at risk, wherein you could calculate the size for a particular trade to make sure that the losses would be at a maximum, but still at an acceptable level, right? So you can calculate that because you already know your entry price, your stop price. You can easily calculate your size to make sure that in even the worst case scenario, you won't lose too much.
I see. So it's quite interesting. You talked about leverage, but maybe not a lot of people really know about that. And, I'm just curious, why do brokers actually provide, margin or lending to the clients if it seems like, the leverage or margin can be a dangerous thing?
Yeah. Okay. So leverage, it's neither good nor bad, right? So traders use it to potentially magnify returns. But of course, at the same time, it doesn't only magnify returns, but it also magnifies losses, right? So there's nothing inherently wrong about wanting to maximize your return, but you always have to be wary about the risk that you're also taking, right? So it goes back to being balanced, right? And making sure that we're going to survive, right? So there are places and times to use it, but you really have to consider the possibility that you're wrong, and if you're still going to be okay with that, or will it be fatal, as you mentioned a while.
So earlier on, you talked about, like an investing strategy, like computing value at risk. So, I'm just curious about your thoughts, because should an investor, just look at the ticker, and like every morning when he wakes up, he opens his account, look at the ticker, and then just buy whatever's moving. let the ticker tell me what I'm going to do for today. Or, I mean, having a plan every day is a very important strategy to manage risk.
Yeah, definitely. So we need to have a plan, right? Because the reality is, when we're in the middle of a trade, we tend to be emotional, right? Because there's money involved. We could make a lot of money. We can lose a lot of money. So the idea is that by having that plan, we would limit our decisions to when we're most emotional, right? And basically make those decisions given certain scenarios even before we make that trade. So the idea is that we can remove that emotion from the story, and we can make better decisions, right?
So in other words, don't just buy anything that moves. Like before you even open your account, start your trading day, already have a list of maybe the stocks you want to buy.
Not just, exactly. But not just even having a list, right? But knowing what you're going to do if it goes up, if it goes down. Do you take profits instantly? Do you add more? Do you cut? Right? And I just remember now that the reality is that trading or proper trading or investing should be boring, right? It shouldn't be exciting. Because if it's too exciting, maybe you're just gambling, right? And you're not really having a definite plan to make money.
Yeah. So I guess the objective of, trading, investing is to make money. And it's not for entertainment, as you said.
Exactly.
That's why we have to manage risk, no? So now, exiting a position. Like, that's very interesting because I think it's hard because if you make money, when do you exit and be happy? When the stock continues to go up, maybe you're not happy. Or are you managing your risk when you exit or when you sell? And then when it goes down, like, should you cut your losses? Like, what is a proper way to exit that allows you to manage risk?
Yeah, that's interesting because it's really very difficult. Exiting is really very difficult because I don't even want to focus on the first part of the question wherein you're asking, like, when do you take profits? If you're in the green, then it's okay. It doesn't really matter. I mean, it's still important, but it's not as important than when you're losing money. And the reason why that one is difficult is because it's accepting a mistake, right? And we all know it's quite hard to accept when we're wrong. To first know that when we're wrong and to accept it, right? But the reality is that the sooner we accept, right, the more we can minimize those losses, right? So we need to make sure, for example, if you're a trader, usually when you enter a position, there's already a point wherein we know that the setup is already incorrect. So we have to follow that stop, right? And that would limit your losses from getting too big. And also for fundamentalists, right, we also have a similar thing. Usually as fundamentalists, there's a fundamental reason why you're buying it, right? But when the share price goes down, then it's time for you to review and to reevaluate whether or not the analysis still holds, right? Because sometimes there's new information that comes out, or you realize that you made a mistake in the original analysis, then we should be accepting our losses and cutting our losses short.
Yeah. So yeah, that's the most difficult part, I think, about managing risk. Exiting properly, accepting when we're wrong, and cutting losses, and maybe on the upside, accepting that maybe we won't get the best price.
Yeah.
If we decide to sell, but yeah, it would help you manage your risk.
Yeah.
Okay, so with that, I'd like to thank you, Charles, for joining us today. So in other words, the importance of managing risk is, being there or having the stamina to stay in the game, and to, before we can even talk about compounding, you got to make sure that you'll survive and, grow your money, and don't have a fatal mistake to the point that, it will be a major setback that you can't grow your portfolio anymore.
All right. Thank you. Thank you for having me.
Yeah, thank you so much. That's it for this episode of the Market Talk series of Intelligent Investing. If you found this discussion useful, don't forget to like and subscribe for more market insights. And remember, stay sharp, stay selective, and as always, invest intelligently.